I think by and large, the demand profile of our business remains very stable. We're certainly in an environment where you're seeing year-over-year growth rates decelerate, mostly as a result of coming out of the Omicron variant influenced comparisons of the first couple of months of the year and really the first quarter of the year into a more stabilized environment, where last year you saw an incredibly robust rebound in leisure travel. And so we're seeing more and more of our growth transfer from leisure-oriented markets to more urban business transient-oriented markets.
I'm here today with Jonathan Stanner, President and CEO of Summit Hotel Properties. Summit was recently recognized with the Best Renovation Award from Hyatt Hotels for the company's renovation of the 150 guest room Hyatt Place across from Universal Orlando Resort. Can you talk a bit about that project and why you think it was so special?
Yeah, we were really proud and honored to be recognized by Hyatt for the Best Renovation Award. We had built a Hyatt House hotel right across the street, and so we were trying to reposition the Hyatt Place to fit with the elevated standard of the Hyatt House. It was about a $40,000 a key renovation. We spent about $6 million. We touched every inch of the building. We did all the guest rooms, we did all the corridors, we did all the public spaces. We even did the exterior of the building to create a better arrival experience. And we think that it fits together as a very nice dual branded hotel. It allows us to cross-sell those facilities, and I think the aesthetic of the project turned out miraculously. So we're super proud of the outcome there, and again, very honored to be recognized by Hyatt with that award.
You recently spoke with Nareit about Summit's entry into glamping. Why has that been the right move for you, and what's different or interesting about it from a financial perspective?
Well, we think it's a natural extension of our core business. I mean, we've always been a believer in owning hotels with efficient operating models. It's been a rooms mostly revenue-driven model for us. We think that they run higher margins. We believe that it drives higher risk-adjusted returns, and we think that glamping sits as a natural extension of that business. We're running very high average rates. We're doing it with very limited staffing. It eliminates a lot of the very expensive amenities and services that come with a more traditional hotel offering. And so it translates into yields that are significantly higher than we're seeing in the traditional hotel space. We also think it fits very well with where we see guest preferences evolving. It's a very experiential type of accommodation. It has a very outdoor nature type of vibe to it. It's Instagrammable. It appeals to a younger traveler base that we think that there's just longer term growth in. And so we do think it fits very well with emerging guest preferences. And the unit level economics of the business are really compelling. As I mentioned, the yields are in some instances 2x what we're seeing in the traditional hotel space. Our EBITDAs per unit can be up to 5 times what we'll achieve in the traditional hotel space. And so that risk-adjusted return profile, or that return profile of the investment, is very compelling for us.
And how would you describe broad trends across the lodging sector at mid-year?
Yeah, look, I think by and large, the demand profile of our business remains very stable. We're certainly in an environment where you're seeing year-over-year growth rates decelerate, mostly as a result of coming out of the Omicron variant influenced comparisons of the first couple of months of the year and really the first quarter of the year into a more stabilized environment, where last year you saw an incredibly robust rebound in leisure travel. And so we're seeing more and more of our growth transfer from leisure-oriented markets to more urban business transient-oriented markets. But we're very encouraged by what we're seeing, particularly in the NCI portfolio, a large portfolio we acquired early last year. We're getting great traction from a lot of our cluster sales opportunities, and we continue to see good growth in urban markets. So while absolute year-over-year growth is decelerating as we would expect, I do think the demand portion of our business remains very stable today.